Hello, and welcome to the weekly economic brief. My name is Dr. Lindsay Piegza, Chief Economist at Stifel. Last week, the economic calendar was quite robust, with an updated look at a number of key data releases, including the all-important PCE report, the Fed's preferred measure of prices. The headline PCE rose 0.3 in February, as expected, and 2.5% year over year, holding steady now for the second consecutive month. Excluding food and energy costs, the core PCE, meanwhile, rose zero point 0.4 in February, a tenth of a percentage point more than expected, and following a lesser 0.3% increase in January. Over the past 12 months, core inflation increased 2.8%, an uptick from a 2.7% pace at the start of the year, and marking now a 2-month high. And one more iteration of inflation, the supercore PCE, a measure of core services excluding shelter, rose zero point 0.4 in February and 3.3% on an annual basis, a pickup from a 3.1% pace at the start of the year, and marking now the largest annual increase since December. Understandably so, with a hotter than expected read on the core PCE, inflation fears are back on the rise. Somewhat calming words from the Fed projecting transitory price disruptions from fiscal policy, coupled with a realized decline in producer and consumer price momentum in February, sent Treasury yields lower last month, while boosting expectations for mid-year rate relief from the Fed. The latest core acceleration, however, at least calls into question that optimistic and rosy outlook, with some Fed officials expressing a higher level of concern regarding elevated prices for, quote, some time. After all, the committee has proven relatively steadfast in its long-standing outlook for inflation to retreat back to 2% for 4 years since the pandemic, but without success. So why will this time prove different? It may not. That being said, while inflation or disinflation has clearly made less progress than anticipated over the past several months, the U.S. economy broadly continues to perform, with ongoing strength propelled by the consumer. In fact, the strength and ongoing resilience of the consumer was also in focus last week with the latest look at the income and consumption reports. Consumer spending increased 0.4%, slightly less than expected, and following a downwardly revised 0.3% decline at the start of the year. Although on an annual basis, consumer spending gained 5.3% in February, still solidly positive, but nonetheless a 6-month low. Income, meanwhile, jumped zero point 0.8 in February, double the rise expected, and rose 4.6% annually, a 2-month high. Of course, adjusting for inflation, growth appears somewhat more muted, or at least mixed. Real consumption, for example, rose 2.7% on an annual basis, down from a 2.8% increase in January, while real income posted a 2% gain following a 1.7% increase the month prior. Taken together, the latest read on the consumer and inflation supports a lingering storyline of uncertainty and sizable upside risks, but still ongoing strength and resilience, at least for now. A welcome combination further exemplified in the latest GDP report. In the final round report, fourth quarter GDP was revised up to a solid 2.4% pace, a tenth of a percentage point more than expected, albeit still marking a 3-quarter low. In the details, there were few notable revisions. Personal consumption, for example, was revised lower by 0.2 to a 4% rise, still marking the fastest pace in 7 quarters, and reflecting both a solid 6.2% increase in goods consumption and a 3% increase in services consumption. Gross private investment, meanwhile, a gauge of business spending, was also little changed at a loss of 5.6%, the first quarterly decline since the start of 2023, reflecting a relatively reduced level of inventories, which rose by just $9 billion at year-end, down from the near $58 billion gain reported in the third quarter. Thus, excluding inventories, fixed investment fell a lesser 1.1% in the final Q4 report, still, however, marking the weakest quarterly pace in 2 years. Non-residential investment, meanwhile, which includes office buildings and factories, was revised up 0.2 of a percentage point to a lesser decline of 3%, reflecting a stronger pace of both equipment and structures investment. Intellectual property investment, on the other hand, was revised down from no change to a half a percentage point loss in the final round report, while residential investment was revised up a tenth of a percentage point to a 5.5% increase, the largest rise in 3 quarters. On the trade side, both exports and imports were in the red at the end of the year, with net trade contributing 0.3 of a percentage point to GDP in the fourth quarter. So, stripping out that sizable drag from inventories, real final sales rose 2.1% in Q4 after a 3.4% rise in the third quarter. While excluding inventories and trade, real final sales to domestic purchasers rose a more solid 3% at year end, albeit still down from a more robust 3.7% increase in Q3. Bottom line, with a slower pace of activity at the end of the year, annual GDP rose 2.8% for the entirety of 2024, while a very slight slowdown from a 2.9% pace in 2023. The U.S. economy remains solid amid ongoing resilience on part of the consumer as well as corporate investment. Also, last week, taking a closer look at corporate America, durable goods orders unexpectedly rose nearly a full percentage point in February, following an upwardly revised 3.3% pace at the start of the year. Year over year headline orders rose 3.4% in February, down but only slightly from a 3.6% increase in January. Of course, at least a portion of that monthly rise was the result of an increase in transportation, with orders up 1.5% following a more than 10% drop the month prior. Thus, excluding transportation, durable goods orders rose a lesser 0.7% in the second month of the year and climbed 2% over the past 12 months, the largest annual increase since December of 23. Business equipment investment, on the other hand, meaning capital goods orders excluding aircraft and defense, unexpectedly fell outright, declining 0.3 in February, the largest drop since July. Year over year, however, business investment does remain in the black, up 1.4%, following a stronger 2.3% increase at the start of the year. Of course, despite still ongoing indications of somewhat solid economic activity, at least for the time being, consumers' expectations appear to be eroding, a justifiable reaction to the growing uncertainty and potential inflationary implications from a plethora of new fiscal policy initiatives coming down the pipeline. The March Conference Board's Consumer Confidence Index, for example, showed such ongoing concern on part of the U.S. consumer, with headline confidence dropping over 7 points to a reading of 92.9 in March, the lowest reading in 4 years. In the details of the report, a gauge of current conditions declined over 3 points, while a gauge of future expectations slumped nearly 10 points in March to the lowest reading in 12 years. Again, a reflection of consumers' growing frustration with ongoing elevated prices and heightened uncertainty regarding the potential impact of tariffs, as well as unknowns surrounding the future pathway for interest rates. In fact, speaking of unknown monetary policy, also last week, a number of Fed officials offered commentary clarifying expectations in the aftermath of the March rate decision and the most recent economic data. Atlanta Fed President Raphael Bostic, for example, said he only expects one rate cut this year, contrary to the median forecast projecting 2 additional cuts in the summary of economic projections. Bostic said given he anticipates the impact of tariffs to prove temporary, further relief may prove appropriate later in the year, but to a limited degree. Meanwhile, Fed Governor Adriana Kugler noted, as consumers have, the elevated level of uncertainty in today's environment and surrounding upside risks to price pressures as a reason to keep expectations for further rate relief muted. Kugler clarified at this point she does support keeping rates on hold for, quote, some time, while keeping a close watch on any acceleration in price increases. Meanwhile, in fiscal policy news, the auto industry is contending with a fresh round of tariffs, as the Trump team announced last week a 25% tariff on all auto imports set to begin April 3rd. Initially, the tariffs will target fully assembled vehicles before expanding to include major automobile parts a month later. Global counterparts are responding with understandable disappointment and frustration, with the latest move poised to disrupt nearly $30 billion in auto exports to the U.S. from the Canadian economy alone. Reports suggest the EU also faces a sizable hit and as a result is looking at retaliatory options, although the White House warned additional tariffs would be considered, at least for the EU and Canada, if they work together to do, quote, economic harm to the U.S. This week, the economic calendar begins today with a look at the March Chicago PMI, along with the March Dallas Fed Manufacturing Index. Tomorrow, we begin with the final March print of the S&P Global Manufacturing PMI. Take a look at February construction spending, the February JOLTS report, and the March ISM Manufacturing Index. Recall last month, the ISM index fell 0.6 to a reading of 50.3 in February, slightly more than the decline expected, albeit still marking the second consecutive reading in expansionary territory, or reading above 50. This month, manufacturing is expected to decline further to a reading of 49.8, potentially marking a 3-month low and the first month back into contraction since December. Also on Tuesday, we'll take a look at vehicle sales before turning to Wednesday for weekly mortgage applications, the ADP Private Sector Employment Report, and the final February print of durable goods. Later in the week on Thursday, we'll take a look at weekly jobless claims, the January trade balance, and the final March S&P Global U.S. Services and Composite PMIs, along with the ISM Services Index. Last month, U.S. services unexpectedly increased to a 2-month high, marking the 8th consecutive month in expansion, or again a reading above 50. This month, the services index is expected to decline slightly to a reading of 53.1, potentially marking a 2-month low, albeit still remaining in positive territory for potentially the 9th consecutive month. And on Friday, the main highlight of the week, the March employment report. Following a slightly weaker than expected rise of 151,000 in February, the March report is expected to show a gain of an even lesser 134,000, potentially marking a 2-month low. The unemployment rate, meanwhile, is expected to remain steady at 4.1% in March for the second consecutive month, while average hourly earnings are expected to rise 0.3 in March and 3.9% year over year, potentially marking the smallest annual increase in 2 months. And finally, on the Fed speak front, we'll hear from at least a couple of Fed officials throughout the week, including Fed Governor Jefferson on Thursday as he participates in a moderated discussion on central bank communication, and from Chair Powell himself on Friday as he offers keynote remarks at an industry conference in Arlington, Virginia. And with that, I'd like to thank you for starting your week with Stifel.